Okay, picture the ultimate stock market showdown. In one corner, you have Cathie Wood. She's all about those young, innovative, high-flying tech disruptors. And in the other corner, you've got Warren Buffett. He is the king of highly predictable, mature, slow and steady businesses. So, who do you think actually performed better? If you put your money into Cathie Wood's aggressive high-growth strategy versus Warren Buffett's classic value-driven empire over a recent 9-year stretch, who comes out on top? Just think about that for a second. Well, the result is absolutely mind-blowing. A $10,000 investment basically ended up in the exact same place. Cathie Wood's investors went on this wild, volatile, heart-stopping roller coaster to reach $23,400. Meanwhile, Buffett's investors took a slow, quiet, steady climb to $24,500. It totally proves that two diametrically opposed investing styles can both successfully double your money over time. Let's dive right into part 1, growth versus value explained. To really understand how both of these strategies won, think of it like drafting a sports team. Are you picking the flashy rookie superstar who has massive future potential? Or are you taking the reliable, seasoned veteran who just consistently puts points on the board right now? Growth investing is all about that flashy future potential. These companies take literally all their profits and dump them right back into the business for massive expansion. You make your money when that share price shoots up. Value investing, on the flip side, is all about current fundamentals. These are your veterans. They're mature businesses trading below what they're actually worth, and they usually pay out steady, reliable dividends while you wait for the stock price to recover. To ground this in reality, let's look at some real-world U.S. examples. Growth stocks lean super heavily into tech and innovation. We're talking about giants like Amazon, Tesla, Nvidia, and Meta. Value stocks, though, they lean heavily toward financials, energy, and consumer staples. Think of those reliable, everyday household names like Johnson & Johnson, Coca-Cola, and Bank of America. When we look at the data from Grimes & Company, the contrast is just perfectly summarized. Growth is highly volatile. It absolutely thrives in a raging bull market when investor confidence is sky high. Value is a lot less volatile. It tends to hold up so much better during bear markets, inflationary periods, or economic uncertainty. It basically acts as a crucial defensive buffer for your money. But here is where things get kind of tricky. Even the major financial index providers can't agree on how to classify these massive companies. Based on data from FTSE Russell, indexers like Russell and CRSP categorize Apple and Amazon purely as growth stocks. But S&P, they actually categorize them as both growth and value. They literally split the market cap between the two styles because these mega-cap tech firms have grown so huge they now exhibit characteristics of both. Moving right along to part 2, 3 mistakes and your investing DNA. Why do so many beginners get completely crushed out there by falling into value traps or growth traps? It almost always boils down to 3 major myths, so let's destroy them right now. Myth 1, value is risky. Nope. Actually, lower valuations and dividend yields act as a safety net during market panic. The real risk usually lies in wildly overvalued growth stocks. Myth 2, value stocks don't grow. Totally false. Over the long haul, value companies restructure, bring in new management, and grow their earnings just fine. And myth 3, value is a dead strategy. Look, while growth absolutely dominated the 2010s, value historically crushes it right after massive tech bubbles burst. And that's because, historically, there is a massive cyclical tug-of-war going on. Between the years 2000 and 2024, growth and value basically just took turns outperforming each other. Value stocks surged ahead after the dot-com bubble popped in the early 2000s, but then growth stocks completely dominated the easy money, low interest rate era of the 2010s. Market leadership always rotates. But here is what most people don't know, and it's a huge curiosity. Do you actually choose your investing strategy, or are you quite literally born with it? Is your preference for growth or value encoded right there in your DNA? This blew my mind. According to research from the CFA Institute looking at the Swedish twin registry, over a quarter of your preference for growth or value, roughly 26%, is quite literally driven by your genetics. There is no way around it. The remaining 74% comes down to your environment and life experiences. Your specific life experiences quite literally wire your brain's financial risk dial. The research showed that if you grow up during a severe economic recession or in a lower-income home, you will naturally hunt for safe value bargains later in life. Conversely, individuals with higher education, higher disposable income, or who show signs of overconfidence bias, they heavily favor growth investments.
Which brings us perfectly to part 3, the golden middle path, also known as GARP.
So what if you're torn? What if your brain is pulling you in both directions and you want the thrill of growth but the safety of value? Let me introduce you to GARP. That stands for growth at a reasonable price. It's a hybrid stock picking style. It hunts for companies with strong future earnings potential, but only, and this is key, only if they aren't trading at absolutely absurd valuations. It lets you invest in super exciting themes like artificial intelligence without horribly overpaying.
And let me tell you, overpaying is a huge danger right now. Just think about this single terrifying number. At the end of 2024, growth stocks were trading at a 48% premium relative to their historical average price-to-earnings ratio. Value stocks, they were only at a 17% premium. Buying pure growth right now means you are paying a massive, massive premium just for future promises.
So how do we actually do this? Here is your step-by-step GARP breakdown. Step 1, screen the market for strong growth stocks that actually have solid earnings. Step 2, filter that list to check for reasonable valuations, weeding out all the overpriced hype. And step 3, tilt your portfolio toward quality fundamentals to reduce your concentration risk. This prevents you from just blindly holding the magnificent 7 tech stocks and crossing your fingers. And finally, part 4, the ultimate investing takeaway. We've covered a ton of ground today, but if you remember only one single lesson, make it this. Growth and value are not opposites, they are complements. A truly great diversified approach blends the high growth potential of certain sectors with the rock-solid resilience and income of others. You want growth to pull you forward during economic boom times, and you want value to act as your anchor during the downturns. Honestly, Warren Buffett himself really said it best. Even though everybody knows him as the ultimate value investor, his philosophy is basically the textbook definition of the GARP middle path. He says, forget what you know about buying fair businesses at wonderful prices. Instead, buy wonderful businesses at fair prices. That is the absolute essence of finding growth at a reasonable price.
I really hope this explainer helped you decode your very own investing DNA. If you found this breakdown helpful, make sure to hit subscribe right now so you don't miss out. And that leaves us with one final provocative question. Now that you know your genetics and your past experiences are trying to subconsciously dictate your portfolio, are you going to let them or are you going to take control? Think about it. We will see you in our next explainer where we're going to be diving deep into how interest rates affect the Dow Jones. See you there.